Hello, my name is Joe Novickis. I teach at Deerfield High School in Deerfield, Illinois. My email address is there at the bottom, so if you have any questions, please feel free to email me and I'll get back to you. I saw some people posted some questions about how they do financial modeling, so I'm going to kind of share pretty quickly on how I do financial modeling in my incubator classroom. And I kind of use a combination of the incubator EDU materials along with materials one of my board members and myself kind of developed a financial model to simplify it a little bit for my students, and it works pretty well, and I'm going to share that with you. All right, so the lesson you want to show them is the 4.2 cost of goods sold startup SG&A from the slide deck from Incubator EDU. And what I like about this is it breaks down the cost of goods sold, startup costs, and SG&A. So what I do here is really understanding and differentiating between the three types. And so what most of our students that are making products, they're going to pay someone to manufacture the product for them. And so basically what they're buying, shipping out the door to them, that's their cost of goods sold. Or whatever it is they're selling it to the retailer for. So we have our cost of goods sold number there. Then we focus on all the startup costs. So students kind of go through, they decide, how much cost they need in order to get going. And what's really important, I think you have to kind of decide, and I think this is the way it's done in the real world, is that startup inventory number needs to be a startup cost. So if we're going to run, let's say 2,000 units to start off with, that inventory run, that first inventory run is going to be considered a startup cost. So that's on the slide here. So make sure that you really hold them to that piece when they come up with that startup cost. And then finally, we have the SG&A. So I'm not really teaching you anything new here. This is stuff that I kind of show them. And I also go to 10Ks of real life companies, and we look at the different numbers. We look at Apple. I'll show you that done to the video real quick, but I don't want to get bogged down with it right now here at this point. So once they identify these three cost buckets and what their numbers are, I will share this financial model that I use, and it's very simple. It's just kind of a one-pager here. It's in Google Sheets. And so what I have them do is I have them decide on how many units they think they're going to sell in each month for the first year. So they're going to come up with a number each month. And the numbers that I have in here are kind of lowball numbers. So tell them not to base their numbers off the numbers. The reason why I'm using small numbers in my example here is that I want them to kind of see the numbers, and it's simple. All right, so we're selling 25 units, and you can see as we're going down the line, our units are increasing as we go on with our business. And then what the sheet does is it totals up year one. Then what we do is we have to come up with percentage growth from year one to year two. So up here, whatever you put in here, the model will then adjust. So if we go with the 30% growth, then this number will go up 30%. Usually businesses, generally when they hit, they're going to grow. They're not going to go up 10%, 20%. It's pretty sluggish for a growth company. So in the model here, I just went with a simple number, but really it's not unreasonable to really have big growth in the first few years of doing your business. So it's okay for them to be aggressive as long as they have a problem that meets a solution. All right, so what we do then is once we have that number, we're going to have then our total revenue. So the total revenue here is whatever we're selling it by. So in this case, it looks like I just put a $5 selling price in. So whatever the selling price is in, it's going to be multiply units. And then the expenses, this is where they're going to have to then look at the other two buckets. So for the first month, they're going to include their startup costs and then the SG&A total, and that goes in here. Then after that, they're just going to have all SG&A in this total expense bucket here. Okay? Plus, they're going to add in the cost of goods sold. So they're going to have to kind of show them, what I have them do is on a slide, I have them show me, okay, what is the cost of goods sold per unit? They're selling 30 units. Let's say they're selling at $10 a unit. So that'd be 300 cost of goods sold plus 200 SG&A would be month two, and so forth and so on. So as they do that, they're going to kind of manually calculate each of them. And I know the Incubator EDU has the different tabs and then it pulls it in, but I want them to physically show me that they know how to calculate that expense bucket, looking at the cost of goods sold in the SG&A. So every month they're to do that. One thing we have to kind of also think about in the corporate world, we have accrual-based accounting where we recognize transactions even though cash isn't involved. Here, I teach, we're doing cash accounting here. So we have to have cash to stay viable in our first few years of business. We need to know how much cash we need. And so I only recognize cash transactions in here. So when we're writing the check for the inventory, that's where we include the inventory cost, not when we sell it off. So there's a big difference there. So for example, if I'm selling if I'm buying 1,000 units of inventory, but I'm going to sell them over the next 4 months in accrual-based accounting, we're gonna call it account payable. We're going to then record the cost of goods sold as we sell the inventory. We're not going to do that here because we got to know how much cash we need to stay in business. So what we want to do as soon as we run that inventory run, we're going to put that in. What I teach is we're going to run our inventory for 3 months at a time. Because inventory, it's not like I just go down to Target or Amazon and I get it right away. There's a waiting time for inventory. And so what we do is I teach them to run their inventory every quarter. So they're going to dump the numbers in every quarter. So once they get that, they're going to get a profit. And then once we get our first year, we put our percentage change, and then we get our 3-year total. So now, once we have this kind of filled out, and I'm flying through this right now, but I want you to see how it kind of plays out. I then take that 3-year total number, and that's how I calculate my pre-money valuation. In the incubator slide decks, it talks about a multiplier. Tech companies are going to have really, really high multipliers. These are high school businesses, let's be real here. So we're going to go with a lower multiplier. So I think a multiplier of 5 is pretty conservative. If we want to get even more conservative, we go multiplier of 3. But I think a 5 is a pretty fair multiplier to use for our incubator students and for them to kind of see what it looks like. So basically, they just take their 3-year profit number, which I pulled from up here. So if I go over here, I got my 3-year profit number, and then I'm going to take that number and I'm going to multiply it by 3, okay, or by 5, I'm sorry. So my 3-year profit times 5 comes out to 21,525. And then I have to look at the beginning of my model. Wherever I'm running a deficit, whenever I'm in the red, I need that cash up front, and that's the funding that I'm requesting. So in this case, and remember, these are just simple numbers to kind of show, but we're running minus 875, minus 350, minus 325, and then we turn cash positive moving forward in this model. And so that comes out to 1,550. So that's the cash that we need up front to keep going in business. And so then our post-money valuation would be the combination of our 3-year times our multiplier of 5 plus the negative cash flow we had in the beginning, and then we get a post-money valuation of 23,075. So then our pre-money valuation, if you take what we're looking for and divide it by the pre-money number, so the 1,500, you can see up here, 1,500 divided by 21, we're with that 1,500, we're going to give 7% equity. And guys, these numbers are really, really low. So, it's just to show you how the model works. And then the post-money valuation, which obviously will be a little bit lower because it's adding that in. So there's the 1,500 divided by the 23. So when you watch Shark Tank, when we watch Shark Tank with them, and they say, I'm looking for $100,000 for 10% of the company, that's how they're getting the number. Now, the question on Shark Tank is, well, how are you getting to $1 million? What multiplier are they using? So that's where the debate usually comes in when you watch that. And I always will show, just a couple segments, not the whole show of Shark Tank, but literally like a 5-minute clip, and we talk about valuation, we bring it to life. And so if you could do that too, that works out well. So this is very simplistic, but what they have to do first is they have to calculate their cost of goods sold number, they have to come up with their startup cost, and they have to come up with their SG&A ongoing. So where they fall short on SG&A because they really have this idea and they think everyone's going to buy it, but there's no marketing. They have to have marketing in their plan, and they can't just say we're going to do social media, because getting people on social media takes money and it takes cost, and they have to include that in their SG&A. All right, so that's the very simplistic of my business model. Let me show you how this played out with the company from last year. So this is a group just to show you for fun. They solved the problem when girls wear multiple necklaces, they tangle up. So they created this magnetic clasp, and they had different versions of it, and they had it manufactured and made. And so it connects multiple necklaces, and it literally you get 2 necklaces on in 5 seconds, and it doesn't tangle when they wear it at the same time. So let's close it out there. So as we kind of look at their model here, so you can see here on the Clasp & Co. they had to break out the slides for me. So there's their they have the cost of goods sold. Oh, let me see here. Sorry about this. All right, so there's the product, and then we get to the startup cost. So the website, the prototype, the initial inventory run. They had 2,000 pieces made. So that's, and then they have their SG&A ongoing, and so they have all how they plan on spending all that, and then they put it into the model here. So there's the model. They have the units, revenue, expenses. They have the first 12 months run out, and then there's the growth, and they kind of went with a slow growth rate there. It would have been nice if they got a little more aggressive, but anyway, the numbers still look good, and it kind of plays out. And so then there's the valuation. So the problem that I think I had kind of, and I told them with them on this one, is that your pre-money valuation and what you need is very, very low. So this would be an example of, well, why would you want to take $11,000 from an investor and give them 1%? No investor would want to do that deal. So sometimes they have to kind of sweeten the deal a little bit and come up with a more reasonable percentage to give to the investor. But at the same time, their numbers are pretty solid there. All right, so that's kind of an example of how they look. And so if you look at all my groups, they all kind of look like that. They're all the same. And really the board and the judges, they all love it because it makes sense. They could follow every group. They don't have to question as much. And we work towards these numbers. And they really lean on the mentors to kind of come up with the cost of goods sold and the numbers that they need to kind of get going. And I told you I use SEC.gov. So if you go to SEC.gov and you go to filings, company filing search, and you just go over here where it says fast search, I type in AAPL. I'm going to go through this real quick. Here's Apple. I want to see their 10K. So I just click on 10-K. And then I click on documents. And then the first link here. I am in now Apple's annual report. I remember back in the day that would take about a month to get in here, to get it in the mail in the dorm room. Now we can get it in 10 seconds. It's pretty crazy. So here we go. We go to financial statements. And so here's what I kind of show them. I say, and kind of looking at the numbers, this is in millions. So being readers of financial statements, there's 6 zeros in a million. So you add 6 zeros to this. So there's their sales, 213 billion. In products, 46 billion, services, for a grand total of 260. But then they have the cost of sales listed here, and they work their way down to their margin at 98 billion. And then here's the SG&A. So it's important to kind of show them this, I think, because there's SG&A, and we're talking about SG&A, and they're like, what is that? Well, that's the running of the stores, the officers, the advertising, But really the impressive number, if you look at Apple, they spent 11 billion, 14 billion, and 16 billion in the last 3 years on research and development. So that's something, as you want to expand your product lines out, you have to have the that cost on there. So if you have a business in your group that wants to add multiple product lines, they have to include that cost. And if they show that to the board members and the judges, they're floored by that they put that thought into their financial modeling. All right, so let me know if you have any questions. I went through this really quick, and I'll share with you my financial model. Good luck, everyone, and hopefully everyone's doing well. And we'll see how this plays out. Thank you.